Hello and welcome to the first lecture for macroeconomics. We start in chapter 15. Just a heads up, the slides are not that great, and so we're going to work with them. Mainly the information is all we're concerned about, but it seems as though, and I'm using the book slides, the publisher slides, it seems as though they're from the 1980s, but that's okay. The information is what we're going to concentrate on. This lecture, we're starting in chapter 15 because the way the book's set up, we chose a new book that was able to cover both micro and macro, and because you're taking macro and the way the book is set up, you're going to start in chapter 15. I will explain a lot of the nomenclature, maybe some of the vocabulary terms that you see, try to catch you up with any information you need to know that may have been presented at the start of the book, even though we're starting in chapter 15. Also, if you ever have any questions, please ask, and I will do my best to answer them. You can always follow me on Twitter. My handle is @ProfKemper, P-R-O-F, as in Professor, Kemper, K-E-M-P-E-R. All right, let's start. So we're going to start off with national income accounting. And so up until a certain point, pretty much the first 120, 130 years of our nation, we didn't really know what the economy was, let alone the study of economics hasn't been around for forever, because Adam Smith was the first person to actually coin the term as far as studying economics as an actual science when he wrote The Wealth of Nations in 1776. So it's not been around, and obviously 1776 should tell you that our nation is pretty young, started in 1776. If economics as a field hasn't been studied for that long, then we really are a current science. And it is a science, and later on we'll talk about that in retrospect to economics. Essentially, it's the study of choices, and we use the scientific method to figure out what causes what and look at it as a whole. But talking about economics as a whole, the macro field, and this is way before micro was even thought of, and economics was just this big field, we started seeing that there was a benefit between trading with one nation and another, and this is when socialism was starting to come about, and then we started looking at capitalism, and especially in America, and it started taking off. And in the United States, we wanted to see how much the economy was growing and how could we quantify it. And so that's when national income accounting started. And the goal essentially was a system in which we could measure the aggregate income and expenditures for the whole nation. And the United States uses a specific measure, and it's called GDP. We're going to talk about it. By far the greatest measure of, I would say, in my personal opinion, of the economy, specifically because we continually use it and we're the world's largest economy. And it lets us know how much we're purchasing, what direction we're going. And that's the big issue. We want to see which direction we're going, if we're increasing, we're decreasing, especially with populace. For a long time in the United States, the population was doubling every generation, if not sooner. And as it does that and people live longer, we have to be able to feed these people. Well, we've also come up with much better ways of handling our food problem, as well as technology and things like that. But all of this relates to national accounting. We got to start with one specific formula to measure it, and that's gross domestic product. Essentially, just think of it as the economy, GDP. You probably have heard politicians talk about GDP. By the way, I'm not very keen on politicians of all kinds. I'm not a Republican or a Democrat. For the most part, I just don't think they really understand economics. They're great at political gesturing, I guess that's what you would call it. They're very knowledgeable in what they do, I'm sure. But as far as the economy is concerned, I haven't met or seen one that has shown to me that they know what GDP is, let alone how to use it. But GDP is just the market value of all final goods and services produced in a nation during a specific period of time. So we will measure the GDP for a year, or more specifically for a quarter. So there's 4 quarters in a year. Take note of that. And we'll say quarter 1, so from January to February, March will be quarter 1. Quarter 2 will be the next 3 months. Quarter 3, the next 3, and then finally quarter 4 is the end. By the way, quarter 4 typically is when GDP picks up a little bit because of the season. I'll talk a lot about that later on. But what you need to know is that it's a specific period of time, and what we can do is compare it to another quarter of another period of time. For instance, quarter 1 of 2014, we can compare it to 2009 and see how much we've grown and where have we seen the growth. And that all relates back to GDP, gross domestic product. Now you saw in red print final goods, and there's a big reason why it's final goods. So let me define real quickly what a good is and a service, and that's what we're measuring, final goods. We usually say goods, and we're talking about both goods and services, but because the United States is essentially a service nation now, then we do need to differentiate some. So final goods, the reason why we measure it only is we don't want to double account, and we'll talk about that more as this chapter goes along, but it's the final good when a consumer, and a consumer is anybody in the economy, anybody in the nation, anybody alive, any individual that buys something. So when you consume this class, you're a consumer. When you buy something from Taco Bell, you're a consumer. By the way, Taco Bell is my favorite restaurant by far. I know it's not Mexican food. I'm from Colorado, so you don't have to tell me what good Mexican food is. I've tasted it in Texas, believe it or not. But I love Taco Bell, and I know it's disgusting. You could tell me it's made out of fecal matter, and I still eat it. It's just so good and cheap. Anyways, off topic. If I eat a taco from Taco Bell or something, gordita, whatever they have, that is a final good. We don't look at me purchasing, I guess more so the Taco Bell purchasing the tortilla as a final good, because now they're going to make that tortilla into something else and sell it to the consumer. So when it's finally sold to a consumer, that's a final good. So the difference between a good and a service. A good is something you can touch. That was my desk I just knocked on. That's a good. You can tangibly touch it. If we buy a desk, a shirt, a burrito, that's all goods. A service, though, is anything you provide to someone or you receive from someone that's not tangible, that you consume that's not tangible, such as a haircut, a massage, maybe teaching, education. You can't really touch it, but you did get something. When you go out to eat, you have both goods and services. You buy food, buy steak or a hamburger or something, and the server waits on you. That's why they're called servers. All right, so what are intermediate goods? And that's kind of what I referenced just a second ago. They're inputs, but we don't calculate them because they're within GDP, because they're not final goods. So the tortillas, the beans that they put into the burrito that I buy. Another good example is my desk, because it was probably manufactured first from wood in a forest, and they sold that wood to they were a distributor to someone else who finally put it all together and sold it to South Plains College. Well, then those are all intermediate goods until it finally became the desk and South Plains College bought it for its ultimate use. So does GDP count intermediate goods? No, that's what I was referencing just a second ago. We don't want to do double counting. There we go. It's similar to if you've had an accounting class, market to market accounting, and what Enron did. So what Enron did, and this is a good way to explain it, is they took all of the income that they earned that month and they put it on their balance sheet. So they have all this income, right? And then they took all the income they're going to get next month because it's promised to them and put it on that same month's balance sheet. And when you do that, you're essentially double counting, because you're going to do the same thing the next month and next month and next month. And that, by the way, that's illegal. Obviously, Enron did a lot of other things that were bad. But in the same sense, we don't want to count something twice, because then we inflate GDP more than we want it to be, and we want it as accurate as possible. The goal isn't to make GDP look really, really big. The goal is to see what direction it's going, and then just go even further within the variables to see what is causing a decrease in the economy, or an increase, because then maybe we can focus on that. So what's the advantage of using GDP? And GDP is by far my favorite measure. Some textbooks, this one in particular, say other things might be better. I just like GDP because we've used it for so long and it's very significant, and to me it gives us a good benchmark. But GDP measures the value using dollars rather than a listed number of goods. So instead of saying, okay, we've got this many tractors, and we've got this many tanks, and we've got this many desks, and this many burritos were consumed, as well as this many football games were watched. Instead, we just put it all in a dollar amount, and we can look at inflation and see where we're headed. We get this nominal amount, and nominal is just face value, by the way. That's an economic term. And we can see how much the economy is valued in dollars. So do we measure second-hand transactions? Since we have final goods and services, what if I sold this desk as a consumer? No, we don't want to do that. The reason why we don't want to do used goods or services is because they were already counted, just like the example we said earlier. Even though it's almost as though it's a second final good. No, it's not a new good, and we want to measure new things that are coming into the economy. New growth. Think of it this way. If you had a $10,000 car and you sold it for $10,000 and then immediately bought another $10,000 car, just a different kind, you wouldn't feel $10,000 richer, and so it wouldn't make sense to count that twice. Alright, so now we're going to switch over to transfer payments and why we don't include them. So a transfer payment is a government payment to individuals, not in exchange for goods or services currently produced. A better way of saying this, because I don't really like this definition, a transfer payment is where an individual gets a benefit from the government that they didn't pay for, and the way it works is someone who paid taxes got their money transferred from them to another person from the government. So essentially education. Right now, some of you are going to school free. Some of you went to school, well, all of you went to school free, unless you went to private education, I guess, from elementary to junior high to high school. I paid taxes, and my parents and among all of the adults in America who earn an income pay taxes, and that federal money and taxes, that revenue, gets transferred from us to education. You receive some kind of education, service, something like that, and especially if you're in elementary or junior high, you probably didn't pay anything to receive that. Even in high school, you probably didn't pay as much as you received in a transfer. Welfare is another example, Medicaid, Medicare, Social Security. And Social Security, not as much so because you do pay into it, but it's technically transfer because the money that you paid in is not the money you're getting. But we don't want to count those because then we're counting things that are not really productive. We're counting essentially money that came from someone else, and it would be just like the car example where if I sold a car, got $10,000, even though I had $10,000 in the bank, I wouldn't have that actually on my asset evaluation or my balance sheet. It wouldn't show that I'm $10,000 richer. Alright, so does GDP measure non-productive financial transactions? We just talked about that. Non-productive, no. Anytime you see non-productive, no. GDP does not count purely private or public financial transactions. So essentially, we don't want to count something that was money just transferred from one place to the next. Such as, I give you $500 at Christmas. Well, even though you have $500 more, we don't count that as actual productive income, you might say, because I lost $500. And so it'd be odd to count that twice. Also gifts, stocks, things like that. We don't count them as transfer payments because essentially what you're doing is we don't count them as, in GDP because they're non-productive. If you're taking a company and you go public and you issue all the stock, well, you're basing it on the value of the company that day. And so all of that stock is essentially non-productive. People pay money to you for it, but the value cancels each other out. However, and this is important, whenever you sell something and you've made a profit on it, for instance, you get interest on your checking account. We might count that. You sell a bond for more money. That could possibly be, or you, I don't know, have some gold and you wait a long time and then you sell it. We might count that. It all depends on how you do the specific transaction. I don't want to get into specifics, but I just want you to know it has to be some kind of production and lead to more production, essentially. Circular flow model. I don't love the one that the book shows you, but we're going to work with it. It's just a model that shows you how all the pieces of GDP fit together. And so I'm going to use a pen and show you essentially how this might work. A lot of animation on this slide. Alright, so businesses, they produce something and it goes, that's supply. We talk about supply and demand in economics often. We'll cover that more as we go along. And essentially in this market, consumers demand it. And so the reason why I don't like this is essentially there should be only two things on here and make a circular model: households and businesses. And the way the market works is households buy things from businesses and then they sell things back to households, or you earn an income or something like that and you buy more, and this circle just keeps getting bigger and bigger and bigger and bigger, and that's how the economy grows. So what is the expenditure approach? The national income accounting method that measures GDP by adding all the spending for final goods and services. So this is essentially just what GDP is, and what we do is we measure everything that was spent for final goods and services. I don't really like this because we haven't used it for a long time, so it's good, it's great for data purposes, but for trends it's not going to be that great yet, but it is good to know. Alright, so let's talk about the 4 variables of GDP, and the book lists them and then goes in detail, and I will go in detail as well. But these are the 4 variables that make up the function of GDP. So if you think of GDP as y equals such and such, essentially it's a function of everything here. F of x, GDP, equals all these things combined. That's the equation right there. So I typically will say y equals, because that's what economists have used for a long time. It's y equals c plus I plus g, and in most books you will see this written as NX. That just stands for net exports. This first one is consumption, investment, government spending, net exports. Now, I want to quickly show you something, because some of you may have already quickly or have noticed that government spending is in there and it's a plus, not a minus. And there's a reason for that. So as we spend more as a government, we bail out companies, we go into debt, things like that, we spend more, we're adding money to GDP. And so the overall economy does increase. The reason why, though, it's still a positive, and you might be saying, well, that doesn't make sense, because it does have a positive impact, but likely it's going to decrease this consumption, and we'll talk about what consumption is in just a second, that people buy things because you're getting taxed more to pay for this government spending, and investments are probably going to go down as well. And so what happens essentially is a sum-zero game. And depending on whether you're Republican or Democrat, you might say that government spending, if you're a Democrat, goes way up, and GDP then goes way up, and this barely goes down. Whereas if you're Republican, you might say that consumption goes down significantly and GDP barely sees an increase. We'll talk a lot more about those later on, both sides and what they believe. But for now, just know that these are all positive. I guess this one right here, actually, I should say, can be negative, and it is negative in the United States because it's net exports. It's its own little function here where we take imports minus exports. It's not a bad thing that they're negative. I'll address that in just a little bit, but these are all positive variables. And if we see GDP decreasing, then we can go and look and see what variables, and that's what happened in 2008, 2009. We saw this decreasing, even though this was increasing, like I said, but it was decreasing rapidly. And then all the components of this variable, the function of consumption, we can look at and see, well, did this one part go down? Was it housing? Yes, it was. Housing went way down. So because people were essentially house poor, then also restaurants and luxury items went down. And we can look at things within GDP. All right, this is a balance sheet, a simple, or I guess just an accounting approach. I hate it because no one would ever really look at it this way. The only thing that I like is that it shows you the percentage. So consumption, and you do need to know this for the exam, so you can put a star by it. Consumption is by far the biggest component of GDP. You can also see our net exports are negative. That's because we import a lot. Excuse me. We import a lot more than we export. So this formula here is just your X minus M. So we sell less to other countries than we buy from other countries. The reason that is, and I'll go ahead and explain it, it's because we're really rich. And the things we produce are so expensive that other countries can't really buy them. They don't like to buy the nice big TVs and the iPads and things like that because they're so expensive, and so they can't really buy it from us. And we don't want to spend our money producing things such as some of the basics of agriculture. We still produce some of it, but a lot of it we import, such as coffee and things like that, because it's so cheap and we can't afford to produce it here because we're wasting our time. We're giving up producing these nice big things, making a lot more money than producing it. And I want you to note this. Economists 100% believe it's okay to have a negative net exports. That's fine. It is not the same thing as having a negative debt ratio or debt servicing ratio. Essentially, having a debt, not a debt surplus, but essentially debt deficit. That's the word I was looking for. So it's not the same thing as government spending so much money that they have to borrow. That's not the same thing. That deficit is not the same. This deficit essentially is just net exports, means we're so rich we can buy other things. Now other little countries, it's a little bit different because their net exports, because they're not rich, should always be positive because they're developing. They need to import a lot of stuff to bring in more money. And so in that case, it would be different. But in the United States, it's okay that we have a negative net exports. That will probably be a test question. All right, what is the income approach? Don't really like this, but it also is in the book, and we need to notate it. It's a method that measures GDP by adding all incomes. Essentially, what it is, if we're looking at it and we say GNP, gross national product, instead of GDP, we're measuring income earned abroad. So if you go over and you're an American citizen and earn money in China or Iraq or any of the other places that are out there in the world but the United States, we don't include that in GDP because it's not income earned through in the U.S. alone, in our nation. And the reason why a lot of economists, and me including, don't really like that approach is because essentially we're saying we want to include all the income earned abroad, but we're not going to honestly not count the money that's earned in the United States by people that are citizens of another country that are working on a visa or something like that. So we're almost trying to tweak the system to our advantage, and that's why I don't really like it. So what are the income components of GDP? Compensation of employees, rents, profits, net interest, indirect taxes, plus depreciation. So this is all the money that's earned in the United States, plus other places, how much money you make. I don't really like that part because you spend that money, right? And that's really when it goes into the economy. If it's just sitting in your bank account, it's not really in the economy, but a lot of people do like to measure this. So I do want to hit on what is compensation of employees. So it's income earned from wages, salaries, and certain supplements paid to labor. So compensation of employees essentially is anytime you work, and labor is just a component of the factor of production, producing items. Whenever you work and get paid, that's compensation. The reason why I do want to differentiate is if I just get, let's say, I got interest from a bank. They said you're a loyal customer. We're going to give you $10 interest. Or I had enough money that I earned $10 interest. It's not labor because I didn't work for it. And that's actually net interest, and that's money that I've earned, and it will go into GDP essentially if you do the income measure, but we don't call it compensation. So we're talking specifically about labor. What is rental income? So this is a little bit different, and not all rent income is just when you rent an apartment or rent a house. You can rent a lot of different things. You can rent buildings if you're someone who leases out to a company. Also, guess what? You can rent your property for someone to farm it. That's known as leasing farmland. You can rent your property so someone can come on your property and hunt, things like that. So anytime you receive that, or even royalties, so every now and then you get money for holding on to your land, and if it's CRP, essentially the government tells you not to farm it, you get some money for that. That's rent. So it's not just rent that you get by renting a house out to someone or an apartment. There are all kinds of things you can rent out, and it's all property, physical property, who you permit other people to use it. What are the two income categories? So it's proprietors, man, I can't say that word. Proprietors, income, proprietors. Proprietors, wow, I could not say that word all of a sudden. Proprietors, income, proprietorship. I'm actually pretty good with words, but for whatever reason, all of a sudden I couldn't. Maybe it's the morning and it snowed and it has not been the best of mornings, but that's okay. Proprietors. Proprietors income. There we go. Proprietors income. We're going to skip past that. And then there's corporate profits. Corporate profits. All of a sudden, I'm getting tongue-tied. Maybe it's because it's getting close to the last lecture. That should cheer you up. So what are corporate profits? This is all income earned by the stockholders of corporations, regardless of whether they receive it. So the reason why it's not just, hey, I got the money back in stock, because the money could be used for other things. It could be used just to hold or purchase assets or something else in the long run. So it's income earned by the stockholders because it's not paid out to the employees, right? It's money that the stockholders essentially have if they want. So what is net interest? We talked about this just a second ago. It's interest earned from loans to businesses. This is a specific one when we're talking about corporations. So if I make a loan to you and you have a business, Tom's Taco Stand or something like that, maybe it's $10,000, you pay me $100 in interest every month as you're paying it back. That's net interest, and that's money I get. What are indirect business taxes? We do need to talk about that. Taxes levied as a percentage of the prices of goods sold and therefore collected as part of the revenue received by firms. So indirectly is essentially a sales tax. So you could be unprofitable and still have to pay indirect business taxes. Businesses do have to file federal tax returns, and at the end of the year, if they have a profit, they have to pay taxes on that. Well, in the United States, some states as well as counties, such as in Texas, because we don't have a state income tax, we definitely have sales tax. And so whenever you buy something in Lubbock, it's 8.25%. That's an indirect business tax. I do want to point out that oftentimes it's not even really a business tax because it's a function of the price, so that it's already built into the price, so we don't even see it. Businesses don't see it. It's essentially within the price itself. So it's, even though it's an indirect business tax, it's within the price. What is depreciation? So if you haven't had accounting, depreciation is as your capital is worn out producing something in GDP, your asset loses value. So if you bought a tractor, after 20 years, it's not going to be that great of a tractor. Or it's going to be okay, maybe 30 years, you're going to start to see some problems, and you might want to upgrade. Well, every year it gets a little bit worse, and so depreciation is essentially taking the value of what you think it declined in value every year. Cars are the worst. Whenever you drive a car off the property, or off the car lot, essentially just depreciates, goes down in value. You can't sell it for the same price because it's just going down and down and down. And that's kind of how we viewed depreciation, is what could you sell it on the open market? That's how much it declined. By the way, homes appreciate, so they go up in value. Most assets, though, depreciate. They go down in value over time. This is just gross income approaches, just showing you the components of GDP, etc., etc. So here, what are some of the shortcomings of GDP? We'll cover these fairly quickly. Non-market transactions. So if something is hidden, for instance, I sell you something on Craigslist and I produce it, I don't file a tax return, then that might be not included in GDP because there's no record of it. Another good example is an illegal alien working for work, and this is one of the problems with illegal aliens, in my view, is the fact that we can't quickly make them citizens. Two reasons. One, we can't quickly make them citizens and include them in the economy and see what's happening in the economy, and two, they are not paying income taxes. And so essentially, even though they're getting a smaller income, and that's why essentially they're getting a smaller income, because they're not paying taxes, we don't see that revenue in the form of the government. Distribution, kind, and quality of goods. So we kind of just use value, the dollar value, and so when we do that, we don't really know, is this good better than that good? I would say Coca-Cola is definitely better than, or Diet Coke or whatever you're going to have, better than the off-brand Sam's brand. Any of the great value brands at Walmart are going to be lesser in value. They're inferior goods compared to others. Neglect of leisure time. So we don't include the amount of time you get to take off work. And in the United States, that's a really, really neat aspect of our lives. We have weekends off, usually, typical job. You're only supposed to work 40 hours unless you work more, you get overtime. And so we don't count for the time we do have off, which is a great benefit. And underground economy, I just talked about that. You do need to know that. I use the word shadow economy. The book will call it underground economy. And that's when you earn money in the black market, essentially. And lastly, economic bad. So I don't like that the book even talks about this, but we could. When we overvalued something, or we didn't account for something, or we had a decline in the economy, we don't measure that value lost. It's really difficult to even talk about that. So what is the conclusion from the shortcomings of GDP? It's just quantitative. It's not qualitative. We can't look at, oh, by the way, non-economic goods could just be your happiness, right? GDP is a quantitative, not qualitative. So quantitative is numbers. So 1, 2, 3, 4, 5, 6, 7, 8. Those are numbers. There is one teacher talking to you right now. However, qualitative, it might say there's one teacher doing a great job right now, or this teacher is doing okay job. It's very difficult to measure those feelings, and that's where qualitative comes in. But it's important, but we can't really measure it in GDP, right? We don't know how much happiness you get from taking off. We just know you get 2 days vacation each week. So this is just what other national accounts measure economic importance. The only one we're going to really spend time on right now is nominal and real GDP income, as well as disposable personal income. We're going to skip this because you can just read it, and we've already talked about it in some aspects. What is personal income? Is all the money you earn, right, from savings and payment of personal taxes, consumption, things like that. That's available for that. All right, let's skip to disposable income. And I promise we were very close to getting done. So disposable income is the amount of money you have after taxes to buy things, right? So the reason why we look at disposable income is if we were only count your whole income and not account for your taxes, you might say that you earn $80,000 when in reality you earn 60 or 65, yet we're saying $80,000, well, there's 15 lost. And we want to be as accurate as possible, so we say after that. And we don't really care that it's not after savings or paying debt or anything like that. You definitely need to know, in economic terms, the financial world, disposable income is not the same thing as after paying your debts. Now, I know budgeting, it's completely different. If you listen to Dave Ramsey, which is a good guy as far as I'm concerned, but not financially as specific as academic world would be in talking about this. And there's reason why we do this is because we're not looking at helping get you out of debt. We're looking specifically, how much money do you have to spend? And if so, what are you spending that on? So that's disposable income. I'm going to skip this. You could calculate on your own. Here's a big point, the last big point of this lecture. The value of all final goods is based on the prices existing during the time period of production. So nominal is just a face value, 1 trillion, 2 trillion. So we take that dollar amount, that's nominal. You earn $80,000, that's your nominal income. Nominal is not very good for GDP referencing, except for looking at face value trends. Whereas real GDP is the one we pay close attention to. So on the exam, we'll talk about both, but you need to know that this is the more important one. It's the value of all final goods produced during a given year based on prices existing in the base year selected. So essentially, it's accounting for inflation. So we can't say that the economy earned 17 trillion, or the economy was at 17 trillion this year, which is 17 times as much that it was at in the 50s. Well, we need to account for price levels. It costs a lot more to buy a gallon of gas, even as cheap as it is, not right now, going down, or going to the grocery store, etc. All those things. So we have to account for the inflation. Shane, I'm going to just skip this because we're not going to talk about that in this intro class. This is some graphs that I want you to look at later on. That's the end of this lecture. Thank you, and if you have any questions, feel free to email me or hit me up on Twitter.